All right, now within the world of investment, we have the world of asset management. And asset management is being roiled now. It's being roiled by advances in fintech, by the changes wrought by artificial intelligence, and by public pressure to adopt more sustainable practices. So we must adapt, we must change, but how will we change? That is what our next panel is getting into. They are going to be led by Harshika Patel, who is the Chief Executive Officer of Asia Private Bank with JP Morgan. She's going to be speaking here on stage with Koch, who is the CEO of TCW. Also joining them on stage is Richard Oldfield, who is the Group Chief Executive with Schroders. Tobias C. Pross is the CEO at Allianz Global Investors, and rounding it all out from Switzerland is Laurent Ramsey, who is the managing partner with the Pictet Group. And with that, Harshika, the floor is yours. Take it away, please.
Right, well, good morning, everybody. Thank you to Eddie, Team HKMA, and Julian team for an absolutely wonderful few days. Do brace yourself for the next 30 minutes because we really do have a high-octane discussion ahead of us on the future of asset management. My guests really need no introduction. Between them, their companies manage over $2.5 trillion of assets. Their companies have over 6 centuries of history, so I'm really looking forward to their insights. Now, because Eric did such a marvelous job of moderating, I feel that I have to trump him somehow. So with that, I took the liberty of having a bit of fun with the CVs of our esteemed panelists and Grok. And by the way, they don't know this is coming. And so I said to Grok, if you have to look, please describe each of these panelists as a financial asset class. Okay, so this is what I got. So Katie, ladies first. Growth equity with a defensive tilt. You thrive in volatility as evidenced by your steering of TCW and Goldman Sachs through rate cycles and mixed market signals. Richard, you're more of an investment-grade bond, corporate bond. Your rapid ascent from CFO to CEO in under a year signals adaptability, while your roots as a chartered accountant provide a moat against volatility. Okay, Tobias, you're more of a large-cap growth equity. You thrive on equity upside, championing where value creation happens, but are buffered by Allianz's balance sheet and safeguards against volatility. And finally, Laurent, you are the perpetual preferred stock. Your cumulative dividends ensure consistency, and of course, you're not the biggest, but the best mantra. Ladies and gentlemen, a big round of applause for our panelists. All right, so now that we've had a bit of the fun stuff, why don't we dive into the more serious stuff? And perhaps, Richard, I'll start with you. So in 3 days' time, you'll be celebrating your 1-year anniversary as the CEO of one of the oldest financial institutions in the UK.
So the key point there, Harshika, is Mr. Trump and I have our first anniversary within a couple of days of each other. That's the only resemblance, by the way. But I think
So, Richard, you set yourself the objective of meeting 100 clients in the first 100 days when you took on this job. What did you hear in those conversations? In particular, what are clients of the future wanting from, the asset management industry going forwards?
Well, it's interesting. I mean, we're very privileged. We serve clients in both the wealth channel and the institutional channel, and of course, therefore, the response differs slightly. I've seen clients now across 28 of the 38 countries that we've been in. Again, you get a bit of a regional flavor. But I think there's 3 common themes. One is, how do you help us navigate complexity? And I was reflecting last night, we spent a lot of time yesterday talking about AI, and it's super important. But actually, our clients are really talking about, we've got a long-term shift in government fiscal positions. We have a shift because of geopolitics. So technology, and I broaden it out past AI, is one piece of all of the changes that they are facing and thinking about. And the word that clicked out of the last panel was diversification. So everyone wants to have diversification, but I think many people are also stuck with FOMO, because actually, if you diversify too early, you've missed out on quite a lot of returns from the concentrated markets that we're in today. So what they're asking for is help us think about shifts in portfolio construction that you've got to do over 18, 24 months. You can't do that really quickly. And how do you help us navigate that shift between the public and private markets? And we forget as an industry, we've done this a lot. You know, whether that was through the financial crisis, the dot-com bubble, the Asian crisis. I'm that old, I can remember the Latin American debt crisis. You know, for many of our institutions who have gone back and thought about wars, we have, as institutions, navigated people's wealth through uncertainty and crises. And I think that's the thing people have been looking for. The second big theme for me is really about asset management is no different to any other industry. So can we have more for less? More insight, more support, and by the way, can your fees come down? And I don't think that's any different to any other industry. And the third thing that probably reflects more of Schroders than anything else is sustainability is still important. So don't give up on it. And we've embedded sustainability because we think it's a really key input into investment choices, because it's about opportunities, it's about risks, no different to actually how we think about technology change. So a very clear message for us has been, don't give up on that.
Great, thank you very much. So Katie, almost taking what Richard said slightly forward in terms of looking after your clients for the long term amidst all of this instability and volatility that the world's seeing. You started TCW a couple of years ago, and when the actual founder, Robert Day, passed not so long ago, he left you with a very powerful message. He said, remember, Katie, you're in the investment business, allow it to compound over time. So what exactly did he mean by that, and how are you trying to preserve that philosophy at TCW? And one thing that many of you may not know is TCW is actually owned by the employees. 44% of the company is owned by the employees. So how do you preserve that philosophy?
Yeah, and what did he mean by it? I think what he was trying to tell me was this: you got a good thing going here, kid, don't mess it up, I think is actually what he was trying to say. But our industry is, and there's a little bit of wisdom in that for asset management, because it's a recurring revenue industry, and every year we start again. We have an incumbent asset base that's generating cash flow, and generally over time, as we know, capital markets go up, and so you're kind of going up and to the right if you don't mess anything up. So there is something to be said about that. TCW, very briefly for people's knowledge, you mentioned Robert Day. He's a scion of the Koch family, which established Superior Oil and Gas, which is the largest independent oil and gas company in America till it was sold to Mobil in '84. So we started managing money for the family. Now we manage over $200 billion on behalf of individuals and institutions. What's special about us is that, number one, we offer highly curated investment solutions only where we have a discernible, repeatable edge, which is in private and public credit, and parts of the equity market where we have a unique insight, like we launched an AI fund 10 years ago. The second is that we have very different exposures from peers and benchmarks. For example, we're 15% underweight credit right now, which we can talk about more later in the panel. And we do a very different type of private credit than all of the scaled players. And actually, we're very nervous about parts of private credit, which we can talk about later. And then finally, because we're privately held and employee owned, we're very long-term oriented in how we think about everything. And it's a very strong investment-led culture. So I'll end by saying that comment, what our job is, I think all of our jobs is, how do you respect the heritage of this very special institution, but also acknowledge that these organizations have to evolve to meet future needs? And that's a very delicate tension that you have to get right. And I'll end with two specific examples of how we do that, and I'll make it brief. The first one would be exchange-traded funds. Mike Gitlin talked a little bit about this yesterday. For a long time, the industry conflated passive investing with the vehicle of ETFs for too long. That became a $12 trillion asset class. Mutual funds were in outflows. I'm looking at Eric Pan, who's in the audience here from ICI, which I'm on the board of, and we celebrated the 100th anniversary of the mutual fund a couple of years ago. So good news, the mutual fund turned 100 years old. Bad news, we haven't innovated in 100 years. So we had to, move along. We launched active ETFs, and it turns out what the clients actually like is they like the wrapper of an ETF, the transparency, the tax efficiency, and the liquidity of it, and we can put active products into those, and lo and behold, we've raised $5 billion in that in the last 18 months. So that's an example of taking that culture and that heritage and that alpha generation and putting it into innovative wrapper. And last comment would be alternative credit. That's a place we've been involved in for a long time. Yes, I think wealth individuals should have access to it. We can talk about that later if we want to. People have talked about that a lot. Actually, though, what it matters for us, the reasons we need to be in alternative credit in the United States is that we have to be relevant to the borrower. And the borrower is the CFO. And the CFOs in the United States and around the world want more flexible forms of financing. They want to be able to borrow in private markets. They want to be able to borrow in public markets. They want to be able to lend against cash flows. They want to be able to lend against assets. The same company can be both IG in the way it's securitized against its asset, and it can be high yield in the way it lends against cash flows. And if we're going to stay at the leading edge for clients, we need to continue to evolve our platform to be relevant to the borrower. So those are two concrete examples of how we can respect the heritage of what we're doing, but meet our clients where they are now and evolve for the future. And my great hope is to make him and the team proud over time and how we do that.
Great, thank you so much, Katie. So Tobias, moving on to you. Clearly, Katie talked a little bit about certain asset classes, which she's probably a bit more happier with versus others. Lots of conversation yesterday around, whether the market's actually overheating, given that whether it's credit, whether it's equities, whether it's gold, whether it's Bitcoin, everything seems to point to all-time highs. So as you think about, helping your clients invest for the long term, whilst navigating these, market conditions, which one's not quite sure where they're going to go, where do you see capital being deployed in your organization right now? And how do you manage risk, return, and impact?
Yeah, thank you for the opening. And I was a little bit digesting when two of you spoke about my growth, equity, whatever, because that has been a little bit under the weather. So thank you. We are definitely not under the weather, but let me first of all thank you, Eddie, for having another HKMA event, which is really stellar. And by end of the day, we can confirm as Allianz Investors, we are a 4-time finisher of the Global Financials Investment Summit Trail. So we are very proud of that. But leave this aside for a moment. We prefer equities over bonds over cash, and I think this is reflected in all the discussions you have heard over the last 48 hours. And if you look into the equity bucket, we prefer very much the EM piece. And this is twofold. First of all, the price momentum is really fantastic. Secondly, we have also heard the structural underinvesting of the westernized world into EM is certainly giving you a great investment opportunity. And within that, you all know that we are very long China. We truly believe China will be an asset class for itself, despite I sound like a broken record on this. And for us, Hong Kong is our gateway, and it's our second home next to Frankfurt and Munich. If you look into the fixed income bucket, we prefer a little bit more euro than US. And this is very much driven by a softer inflation. This is nothing about the tariffs and tension. It's just fundamental underlyings. And within Europe, look, sovereigns is a topic which we work closely monitoring. Our French neighbor is giving us a little bit a hard time because they became a little bit unreliant in terms of who is the next leader. And this is normally something which we had been not used to, because there was always, in Europe, when there was a crisis, Europe always evolved stronger, but it had a very strong axis between France, Germany, or Germany, France, however you want to place this. And there is now, I think, stimulus coming from Germany, and has been mentioned yesterday. So the likelihood of Germans are liked in Europe is a little bit lower than Richard. Everybody likes Richard. And Laurent, obviously, I mean, you anyhow, but you're not part of Europe as a Swiss. Oh, I forgot you're also not part of Europe anymore. So I'm the only European on this panel. I apologize.
It's nice to hear the Germans moaning about the French and not the Brits for a change.
It's television, so 30 seconds back play.
Are we going to have a conversation about Brexit in a minute as well?
Yeah,
because we can talk about that and change the panel discussion.
We promised you an informed panel, right? So we will take over in a second. But let me finish that idea on also, look, the US this is not a bend or break, it's really the US currency is tested as one of the reserve currencies. And this is why we like gold, and we also like steepness on the fixed income side. And what we really like is, and that has been touched upon yesterday, is private markets. We are big in energy transition. We have heard yesterday everybody likes data centers. Please continue to build all the data centers, but do buy our electricity. Because in Europe, we are one of the large providers if it comes to energy transition. So there's really, I think, enough wiggle room. So it's, as Richard said, it's really our investment style which goes beyond alpha, which we try to educate and to help and navigate in these times.
So given that, what's the portfolio of the future? Is it 60-40? Is it 60-20, 20 alts? What is it?
Look, I mean, the catch-up, it's a fantastic question, but you have seen that across the world, most of the portfolios, and this really differs between institutional investors, wholesale, retail investors, where institutional investors are much more advanced already, given the accessibility. We have talked yesterday about democratization. I don't like that democracy. I truly believe making private markets investable for retail customers and wholesale customers is the much better term. But I think at the end it will be pretty much a 70-30, 60-40 split going forward.
But Tobias, sorry, can I just...
No, please.
Total chaos.
So are you disagreeing already?
No, well, I am actually, because I think it depends on the investor, because, you know, there are many people now entering a decumulation phase, and we've seen that change a lot in the last 10 years, and therefore the weighting towards fixed income is going to be higher. I think there's also, we don't talk about it enough, we're holding fixed income for the reason we used to hold it 20 years ago, which is yield, as opposed to a benefit because of the lack of correlation. So we're actually, bonds and equities are looking highly correlated, so it's really giving us yield in the portfolio, which enables you to wind down the...
I would agree, but look, the problem we have within DB/DC plans, our thinking was wrong for decades. Regulation has forced us to divest to the point when you go into your pay-as-you-go system. Have not taken into account that it will most probably, as we all age better, younger, we see it here in the room, that you have to invest another 25 years if you're in retirement. And then only sitting on bonds is not a smart thing. That's the reason why I said 70-30, 60-40.
Okay, so got it. So, okay, so Laurent, we're not going to be always just sitting on bonds as we look forwards. Private markets is clearly something that, you know, institutional investors have had the privilege of investing in over many years and building a much more diverse portfolio. You were famous for saying, as you know, a lot of asset managers lean into the launching of evergreen funds, right, and making private markets more accessible to high net worth and retail more broadly. You said, be careful of making something illiquid liquid. So with that, how do you balance innovation, giving investors what they want, but then managing risk?
Yeah, I think well, first private markets, you know, are gonna grow. You know, it's estimated to reach 30 trillion by 2030. A big part of that growth is still going to be in the hand of institutional clients, which will be north of 20 trillion. And the rest will be in the hands of individuals. Now, 90% of that is still going to be with family offices and ultra high net worth clients. So when we talk about evergreen, I think one, you know, obviously there are benefits, you know, immediate exposure. You can also increase your exposure. You don't have to manage the commitments. But there are a few pitfalls you need to be careful about. First, I think you need to look at what's under the hood, because it's not one for one with you know, traditional closed-end structures. There are also some asset classes that are better suited for evergreen products, you know, shorter duration type of strategies. There's the valuation question, and most importantly, there's the liquidity question, because you're not going to get the liquidity when everybody wants it. You're perhaps going to get it when you want it, but if there's a systemic risk happening, you're going to be gated. You're not going to get it. So it's extremely important when we talk about democratizing access to private assets and to illiquids, that we understand clients, their needs, beyond what they tell you, and that we really focus on the longer term part of their investments, their reserve assets. And as it happens, the wealthier you are, the more funded you are as an institution, the more reserve assets you have to invest in liquids. So my worry is that because there's an element of illusion of liquidity in evergreens, through what we call the democratization of private assets, we start to tap into the core portfolio of retail investors that need cash flow, and we lock it in liquid evergreens that are not liquid. So this is my worry, and this is why we really try to spend a lot of time understanding our clients, understanding why they invest, what their needs are, to make sure that we invest in a suitable manner for our clients.
Katie, any thoughts on that?
I agree with what you mentioned. I think we do have to be thoughtful about it. I also just want to say, someone made the comment yesterday that the death of the 60-40 portfolio has been greatly exaggerated. I do think we need to be open to the possibility that this is something more that the industry is pushing than the clients are asking for. I think about my mom, who's a retired teacher, and all of her friends. Americans aren't complaining about their retirement portfolio. Owning U.S. equity at a low fee has been one of the best asset classes to own in the world over the last 2 decades. So I actually think we've done pretty well for people in terms of capital market returns in their retirement portfolio. Is there room for improvement? Yes. Do I own some of these assets myself? Yes. But I agree with the comments that we have to think about how to structure it responsibly. And when the base rate comes down just in private credit, you're talking about locking people up for an 8-9% return. I mean, in liquid fixed income, you can do that in an ETF for 35 basis points and take intraday liquidity. So I think we have to consider the return profile of what we're asking people to buy along with the structuring of it.
I think it's a very good point. I think, the 30 trillion of assets by 2030 is going to be 20% of the industry AUM, but it's going to represent 40% of its revenues. So who has the real interest in pushing it, down?
Yeah.
Is it the asset management industry, or is it the actual retail clients who want it? I think we need to ask ourselves that question.
Can I add an angle to this? If we look at the needs of infrastructure investments, if you think about Europe, because what I like about Hong Kong, and I travel on to Tokyo and Singapore, if you come back from Asia, sometimes it's fun to enter into a Lufthansa plane and they say, Guten Tag, Herr Pross. Somehow I do fly back into a museum. Right? So if you travel Europe, our need in really renewing grids, making grids available and that electricity can flow from the north to the south, where we have water, where we have wind in the south and west to east, will need governmental stimulus. And as we have seen after COVID, some governments have a very stretched balance sheet. So it will need the money from retail investors. And if you look at Germany, and I think the same is true, the savings rate in Switzerland, in the UK, look, the Germans sit, just to give you a number, on 10 trillion cash. I mean, if they would start to invest in a kind of a public-private partnership model, where somebody is taking the first loss or is doing first loss leaderships, providing guarantees via development banks, I truly believe that our industry is innovative enough to come up with vehicles like we have it on the LTIF, with active ETF on the public listed side, that we can make even complex investment structures accessible and investable while not compromising on liquidity.
So that brings me to my next question, and maybe Richard, you can take this one. Private credit as an evergreen asset class versus infrastructure as an evergreen asset class versus buyout as an evergreen asset class, all very, very different risk profiles. How do you think about that?
Well, we offer all three through an evergreen product, right? So, because I think this comes back down to, forget what we think is an industry, what does the client want, right? And I think I really will double down on Katie's point of some people want to have access. If you have asset-backed short-term private debt, that fits naturally, much more easily because it turns over quickly into an evergreen debt product. You can absolutely, one of our most successful evergreen product is private equity. And of course, we increasingly put renewable infrastructure into evergreen structures. But for me, it comes back down to what does the client want? What is their risk profile? Because again, Tobias is right, Tobias is right, we can do whatever we want to do in terms of innovative structures. That's how we've survived this long. But actually, it is what is right for the client. And I do worry that sometimes as an industry, we don't start from the client lens. We actually start from the how would we like to raise assets. And the moment we do that, by the way, I don't think we're serving ourselves or the industry particularly well.
Before I come to a topic which is about energy and off the back of infrastructure, question for 3 asset managers. Is there not enough money in institutional pots that will help you grow where you need to? Why do you need to access the high net worth and retail?
Well, I'd turn that around the other way. What is the fastest growing source of money? It's wealth. Actually, by the way, in this region, wealth asset growth is forecast to be 2% higher than the average for the rest of the world. You know, you look at the latest forecast for China is that ultra high net worth will explode by 47% by 2028 relative to 2023. That money needs managing, right? So actually what we should be doing is pivoting to where the client needs us, and therefore we need to pivot into that channel, and some of it will flow into institutional channels because people will still invest in their pensions and all of those good things. But we have to service the money where it develops, but we do have this responsibility to make sure the product that we create is right for that channel and right for that individual segment of that channel.
Great. Okay. So, Katie, we slightly touched on infrastructure as part of that conversation. Clearly, the whole energy space is part of the broader infrastructure conversation. How are you thinking about investing in the energy space, sustainable energy?
Yeah,
TCW?
so when at TCW, if I think about the themes that were most overweight across the platform, one is AI, and that's something we're spending a lot of time on as a company, implementing in the way that we run the business and the portfolios. And the other is energy. And there was a great panel on that yesterday. I agree with Jean's comment. That was one of my favorites, probably because that's how we're positioned. Everybody likes to hear that they're right, so that's always good. But there was a lot of comments on there around the massive shortage that we have. And just for people's edification, in order to achieve the dream of AI, we have a lot of work to do in the US in terms of energy. And in our portfolios, we're overweight the creation of energy in alternative forms, wind, solar, nuclear. There's 90 nuclear plants in the United States. Only 3 have been built in the last 10 years. There's 10 just taken online now. And in the more efficient production of energy and storage of energy. Part of it is AI, as I just mentioned, but actually it's also because we are reshoring manufacturing and we're electrifying other things in the United States, including EV. So energy is a sector that grew effectively at zero, so didn't grow for 20 years. And now we're looking at the next 20 years and it's gonna have above GDP growth, and it's an incredible place to be invested whenever that happens to any sector. When you go from below to above GDP growth, you can capture outsized returns, and that's what we're doing in our portfolios. I just want to end on a comment about society quickly and climate, which is there was a comment made yesterday, I think Eddie might have made it, that green energy hasn't been canceled in Hong Kong. And I think that's amazing. Hong Kong has a lot of amazing attributes, and China, and its leadership on this front is notable. I want to put forward that I actually think we're at a really interesting inflection point in the US, where the United States may take a leadership position in driving clean and alternative energy, but in a very unexpected and very American way, which is that we tried very hard to persuade people that it was the right thing to do morally, and we all watched Inconvenient Truth and saw the pictures of the drowning polar bears, and I don't say that lightly. Like, I am a climate victim, by the way. I lost my house in a wildfire this year in my town, and 4 employees at TCW did, and my kids were at a camp in Texas in Kerr County that had a catastrophic flood. Like, I have personal impacts to climate, and our clients are struggling it with insurance companies. It's a real issue. America knows it. We couldn't do much about it. We tried hard to get around it. Nothing happened. It got politicized. Now, though, in the strategic chessboard of capitalism, to get to that promised land of AI, we first have to climb this mountain of energy. And in order to do it, we need every single type of energy, including alternative energy. And nothing motivates an American like climbing that mountain to make all that money on AI. And if there's $60 trillion of labor and we can get 15% more productivity of it, I predict you, we will climb that mountain and we will become the leaders in alternative energy, but for a very unexpected reason. That's what I think.
Okay, thank you so much. All right, so no panel is complete without talking about AI, clearly. So I wouldn't want to, make the audience feel left out that we haven't touched on it. Laurent, why don't we talk about it with you and Tobias? You've both talked about embracing AI in your organizations. Lots of discussion around, lots of money being poured in, but what is the actual end utility going to be over and above just making us a lot more efficient? So can you talk about AI in your organizations in the context of how it's going to help you make more money?
Look, I think we do not differ from anybody else in the room here. We went from a testing, piloting phase into implementation, and I think along the value chain, the most obvious pieces are what we do on client reporting. How do we help portfolio managers to digest data in a better way? But it's not healing all wounds. And look, our industry pretty much is under cost pressure. Now you can take two angles on AI. I mean, if you ask McKinsey, they will tell you 30% always is possible to take out cost. The problem really is, if you communicate this to your staff, it also needs a cultural shift that they accept employment of an AI employee. So do you get a completely virtual, augmented version of yourself next to you in the team? And would you accept this? And I think this is the biggest challenge in our industry, to not only convey the message that AI can certainly do a lot on the productivity efficiency side, but the question really is where to deploy quickly to showcase to staff and to clients that it's worth the way and the effort. And I truly believe this is just the beginning, and I have heard the Taylor Swift comment, so I have two teenagers and one grown-up at home. So Charlotte would say Taylor Swift, maybe. The boys would say, yeah, Taylor Swift is cool. So I have a 2/3, 1/3 at home. But AI is, look, it's unstoppable. But I think it needs to be carefully deployed. And we also have to say, if it's only about efficiency, what do we do if we let a third of our staff go? So what do you do with that? So we are rather in the camp that we want to deploy it on the top line. So it's a growth accelerator. So do more with the same amount of people is certainly the way forward.
No, absolutely. Laurent, anything to add there?
Yeah, perhaps three points. The first thing we're doing for when we look at 2030, we have a couple of principles that we have outlined. One of them is to try to be lean and mean. And what that means basically is that we're gonna
Wouldn't see you as me.
more or less cap people and uncap technology, and that will help us scale up and force the deployment and the embracing of AI technology throughout the organization. The second thing we do is that we've launched an AI-driven strategy where most of the investment process is AI-driven. It's been one of the most successful launch we've had in the last couple of years. So trying to bring AI in the investment process and help us be better investors.
How is it performing versus human
It's been
being?
performing, but it depends which human beings, right?
An intelligent human being.
It's been doing well. It's outperformed its benchmark. It's a relatively new strategy, but it's close to 2 billion now. So it's been very successful in terms of raising assets and gaining interest. And the third thing is to try to, as you know, we're quite big in thematics, try to invest in themes where we think that are going to benefit from AI outside of the Max 7. So you can think about robotics. We launched our strategy 10 years ago. It's outperformed more. I mean, did more than double the performance of the MSCI ACWI since inception. We like cyber. We like so we have a security strategy as well. We like a biotech, which is going to benefit from AI. So try to provide those products to our clients that are going to be big beneficiaries of technology developments.
Fabulous. Exciting times ahead. Okay, folks, I'm conscious that we're out of time, so I figure we end the panel the same way that the previous panel ended. You are all regular visitors to Hong Kong. You've all got growing businesses in Hong Kong. Laurent, Hong Kong in one word.
Well, somebody said already Long Kwai Fong.
No, that's not one word. One word.
That.
I went to the man first because you normally ask women talk a lot, which is why I was going to give you more time.
Energy.
No, that's not one word either, Tobias.
But look, Hong Kong is so beautiful, you cannot describe it in one word. So it's like a nuclear plant. It's cheap and endless power.
And now we wonder about Brexit. Right, Richard.
Energy.
Energy. You just said exactly what Laurent said. Okay,
He always does.
I'm relying on the French speaker.
That's what he did in the prep session as well. He was just repeating us.
You can imagine how difficult the prep session was, ladies and gents. Katie, please say something enlightening. Leadership. Love it. With that, ladies and gents, thank you very much. Thank you, folks.